This is ContactTalkRadio.com. Consciousness in action. And you are taking action into your consciousness by tuning into Contact Talk Radio.
And on TuneIn.com, Ping.fm, and UpSnap Mobile.
Contact Talk Radio.
When was the last time you felt inspired? Are you ready to take your passions to make a difference while living a life you truly love? Your host, Katana Abbott, who is a life and legacy wealth coach and certified financial planner, searches the world to bring you experts in the field of personal and professional growth, wealth creation, and mind, body, and spirit. So grab a cup of coffee and take that quantum leap you've been waiting for. Smart Women Talk Radio, the link to live with purpose, passion, and prosperity.
Hello, everyone. This is Katana, and I welcome you to Smart Women Talk. And I really do search the world for smart women and a few good men. This includes best-selling authors, thought leaders, and change agents who are on that leading edge. So we have topics like money, business, health, inspiration, and the metaphysical. Today, we're going to be interviewing President of Atlantis Mortgage. His name is Jason Yourofsky. We're going to be talking about creative mortgage options, both pre and post-retirement. We're going to talk a little bit about why a reverse mortgage or a forward mortgage might be something to explore before or even during retirement. Also, for working with your loved ones who may be aging and want to age in place. So that's going to be great to hear about this. And with rising rates, what do you do now? How to make the right choice when looking for your mortgage? We're going to talk about common mistakes people make when they're going out to get a mortgage. So in a moment, I'm going to introduce you to Jason. But first, I want to do my tip. So November, we're doing the show live in the month of November. November's National Caregivers Month. So if you are on our Smart Women list, and you do that by going to joinsmartwomen.com, and it's totally free, and you get tons of benefits, and you get my ebook, our newsletter. It just comes once a month. We don't drive you crazy. But you do then get access to who's coming on the show, expert articles, book reviews. We've got a movie review that's always phenomenal. So go to joinsmartwomen.com. So this month, our newsletter, our focus has been preparing for care. What kind of care? Caregiving. Caregiving, care receiving. So, and I know this is a big issue for many of you because in our recent survey, 72% of you told us you wanted a course, you wanted more information on how to prepare for care, either as a caregiver or a care receiver. So I am working on that. I've been a caregiver myself with my mom and dad. This is my stepfather and mother, also with my grandmother, my great aunt, and I've worked actually with hundreds of clients over the last 30 years, helping them prepare for this mentally, financially, legally, getting organized, and finding the right people to put on their team. Because I always say, don't wait for the triggering event. The time to prepare for care is now. You never know when someone is going to have an accident, or my stepfather, I got a call in the middle of the night that he had lung cancer. And that really was something that turned my life upside down, even though I was all prepared. So make sure you start preparing as soon as possible. So according to the Society of Certified Senior Advisors, and I am a certified senior advisor, so when Social Security and Medicare and Medicaid were first designed, life expectancy was around 63. What is it now? It's in the 80s. Today, our fastest growing population is 85 plus, and 50% of them have some form of Alzheimer or dementia. And by 2030, and guess what? That's only a little over 10 years from now, 70 million people in the U.S., or 1 out of 5 people, will be age 65. We have this baby boom retirement going on. And get this, over 1 million people will be 100 years old. So according to the longtermcare.gov website, someone turning 65 today has almost a 70% chance of needing some type of long-term care services in the remaining years. Help. It could be cognitive awareness like the dementia, but it could be just help with dressing or bathing or, feeding themselves, getting around the house. And women need care longer than men. It's about twice as long. And the majority of long-term care is done where? Not in a facility, not in a nursing home. 65% is done in the home. And that's why today I'm so thrilled to be interviewing Jason Yourofsky about a little-known government benefit that allows seniors to access the cash in their home so they can age in place. Now, it's not for everybody, but for some, it can work out really well. So you have to find a trusted advisor. I just went and spoke with Jason with one of my clients, and we were referred to Jason through an elder law attorney. So you want that kind of an introduction. So someone who is an expert in that area. So there are other options as well. And in our next show, we're going to be continuing this conversation with elder law attorney Nicole Whipp, and she's going to be talking about how to stay out of probate and the way you can qualify for government benefits like Medicaid and veterans benefits. So stay tuned. This is really important information. So anyway, that was my tip. It's never too early to prepare. Don't wait for that triggering event. Do it now. Okay, so I hear Jason's on the line, so we're going to take a quick break. And when I return, Jason's going to share the secret to finding the best mortgage options to help ensure a comfortable retirement for you and your loved ones. You are in for a great show, and we will be right back.
Smart Women Talk Radio is brought to you by Smart Women's Empowerment, a 501c3 nonprofit project of the United Charitable Programs. At Smart Women's Empowerment, their goal is to inspire and empower women and girls to live more confident, joyful, and abundant lives by supporting mentoring, financial literacy, and entrepreneurship. Join them today at smartwomenscoaching.com for your free prosperity video training, daily inspirational tips, and how to access over 200 radio shows and free resources from their new Smart Women mobile app. Simply go to smartwomenscoaching.com now to get started.
Hi, and welcome back. I'd now like to introduce you to our guest. Jason Yourofsky began his career in the mortgage industry in 1997, fresh out of Michigan State University's Eli Broad College of Business. He learned the ins and outs of the mortgage industry at a small lender for 4 years before founding Atlantis Mortgage in 2001, where it was formed under the premise of no closing costs purchase or refinance. Jason noticed people were looking for an alternative to the big bank's fees and costs, so he created the no cost, no fee purchase or refinance. So Jason and his team have closed $2 billion in mortgages within the state of Michigan and another $250 million in refinances and purchases outside of Michigan. So Jason, welcome to Smart Women Talk. I'm so excited to have you here today.
Thank you again for inviting me. I look forward to it. This is great.
You know, it's always nice when I interview people from all over the world. And so when I have someone that's local that I've actually met, it's really exciting. And so this month I'm able to interview you and Nicole Whipp, who I met she was doing a seminar on elder law planning, on caregiving, but protecting assets, that type of thing, from long-term care and how to qualify, because she does a lot of seminars. So I'm excited to have you both here during National Caregivers Month to share some of the ways people can create funding, because you heard of my tip. I mean, a lot of people, our aging population is growing so much right now. And this idea of the reverse mortgage is so important. But before we get to that, because I know everybody wants to hear about these, they see them on TV, but then they hear bad things too. Right. Yeah. So before we do that, you've been in business for a long time, and I know people are probably calling you. I know my daughter's thinking of buying a house, and they're probably very worried about the real estate, how high it is, and then putting that together with the rising interest rates. Should people be worried? Can you share some of your wisdom with us right now?
The honest answer is people should always be worried. When people aren't worried, that's when you should really be scared. And that's what I say about complacency. Like market, people have seen it floating nowhere but up over the last, 7-8 years as a trend. When you see things like that, same thing happening with real estate since the collapse, which peaked pretty much in 2012 to 2013 as far as a trough. Now we're back up to levels that we've never seen before in many markets. I always like to look at markets such as San Francisco and New York, the two bellwethers. We've got East Coast, West Coast, two highest price zip codes in the country, take place in both within those two city limits. And you see that sales in San Francisco year over year basis are down 12%. New York is pushing 20%. So when you see the highest price areas in the country start coming off of their peaks as far as number of homes sold, you also start to see it trickling down even here in the Midwest. For example, in Michigan, homes sold over $1 million have decreased somewhere around 20 to 25% year over year. Always seems to start with the people that know. And the people that know, those are the ones buying those homes over $1 million. So I wouldn't say fear, but I would say that people really should be keeping an eye on everything from their financial portfolios all the way to their homes and what they would purchase today. Realize that home prices up until 2010, 2009, nobody thought a home price would ever decrease. Well, we learned the hard way that they don't just decrease, but they decrease incredibly rapidly when there's a big sell-off. Don't think that's going to happen, but we don't know what's about to hit the next downturn.
Yeah, we don't know what's going to happen. So what are you telling people who are out there in the market right now?
Well, it's very interesting because they're different markets. Just as a whole, if you're looking to purchase a home, what we would call a starter home between 100 and 300,000, you'll learn that there's sometimes 5 to 10 offers for every home. If you're looking at a home, the move-up home, call that 250 to 500. Now, there's a little bit more stagnant market conditions in that price range. So it's truly different depending upon where you are. A lot of my retirees are concerned as to what's going to happen if the values go back down again, because everybody lived through that 08, 9, and 10. And the truth of the matter is if you're in the home you want to stay in, today is the day to act, because home prices have never been higher. Could they go higher? Absolutely. But when dealing with either a reverse or a forward mortgage, you want to make sure that you're dealing with it at a time when your appraised value, which is the value of a home based on an independent valuation, would come in at the highest. That gives you the most options.
So it's a completely different market for people that are buyers or sellers.
Absolutely. Absolutely.
The sellers with the real expensive houses, they're getting more nervous.
Absolutely.
Yeah. Okay.
So in all reality, most people that are living in a home of $1 million plus, that's not the customer that we're going to be dealing with that's going to be utilizing a reverse mortgage. It's typically the client with a home value anywhere between 100 and say 600,000, which encompasses the majority of the United States. So those are the people that have seen their values in 07, 8, and 9 decrease. And then from 10 and on, they've seen those values come back to what I would call, in most areas, a historic level. that's the time again to act. You act when everybody else thinks things are good. That's the time to be more cautious. So this is the time to get your finances in play. That and rising interest rates. As we know, we've seen it over the past year. Mortgage rates have increased 1.25% to 1.5% from their all-time lows.
So what are some strategies, and we'll get to the reverse mortgage in a little bit, but what are some strategies for people listening to get the best deal on their mortgage?
Well, it's interesting you say that. Many people think the best deal is the best interest rate. So what people do is they go online, they go to Zillow, they go to their local bank, and they shop for the lowest rate. Well, most people don't understand when shopping for a mortgage, it's not the lowest rate, because the lowest rate comes with the highest cost. It's the lowest rate for your particular situation. And I always say to a client, how long do you plan on being in this house? If this is your forever house, we look at it as a long-term investment. But many people are saying it's a 5-year, it's a 3-year, it's a 10-year project. So if they're planning on moving at some time in the future, I always say to a client, take the bank and take them to task. Ask them where they would recommend you being at with no fees. And every bank, with the exception of a mortgage company like myself, a mortgage broker, will take a step back and say, there is no such thing as a no-fee mortgage, because somebody has to pay those fees. The difference is you can have that bank pay those fees for you. For example, if today's rate is 5% at a bank, I would recommend taking 5.1. Why? Because that payment may only be $20 higher, but the bank in many instances will pay all your fees. The reason I always tell a customer to take that 5.1, which seems counterintuitive, is because if rates come back down, even slightly to 4.5, you refinance or redo that mortgage again. If it never costs you anything, the bank pays the fees. Almost like a stock, you're always going to be at the lowest possible rate. If you pay the fees, what did you save? $20, $30 a month? Doesn't ever make sense to do so, since fees are between $2,000 and $3,000.
Now, do you see most of your people are in their house for a shorter period of time, or are most people buying a house that they're going to stay in for 10, 20 years? Like, what do you see?
Well, millennials, which came on the market in droves during this last 6 to 8 years, are completely different buyers than my generation, the Gen Xers or baby boomers, for example. When a baby boomer bought a house, it was a forever home.
Yeah.
When a Gen Xer bought a house, they had a game plan. This new generation, sometimes they're looking at a 2-year home, maybe a 3-year home. There's quickly as the market changes in a certain environment, they'll go from a downtown environment to a suburban environment. They'll go from not caring about a school district to caring about a school district. So there's going to be a lot more transactions that occur over the next 10 to 15 years, because this is more of a mobile market than, say, different generations have passed.
And just curious, do you see a lot of the millennials wanting to buy a house, even though they seem to change jobs a lot and may have to move out of state?
Yes, because they were missed out. They feel like they're the generation that missed out because of the recession occurring at the time that many of them came out of school. A lot of them had to delay financing a home because, one, they were either financing their college degrees, which many of them still are, with student loan debt, or many of them just feel like they missed out. And a lot of those people are heavily invested in the stock market, where I myself am not, because I feel as though we may be at a peak. So these are the ones that are, as a whole, 25 to 35-year-olds, they're the strongest buying force in the country right now. And they're the ones that are really gobbling up that entire market share of homes between, say, 100 and 300,000, what we would consider a starter home in the United States.
Yeah, and I know a millennial couple just bought a house in that price range, the higher end, and they've got $500,000 in student loans between the two of them.
Oh my goodness! Yeah, we see that all the time.
High-paid professionals, but wow, I've never had student loans, but when young people come to you, when they go to get the mortgage, I don't know what a loan payment even is like, honestly.
Oh, well, let me give you a good rule of thumb. A rule of thumb on a 30-year fixed mortgage, which is almost every mortgage out there is a 30-year fixed mortgage. 9 out of 10 of them that are written, so we'll use that as our guideline. Mm-hmm. A good rule of thumb is in today's market, it's $650 for every $100,000 you borrow. So that gives you an idea of the mortgage payment plus taxes. So many of them have student loan debt that far exceed their mortgage payment. Their mortgage payment is actually one of the least expensive things they have.
Well,
So
that's what I
why
was just
consider
going to
buying.
ask you. Yes.
It's unbelievable. I mean, I have clients that come to us with $150,000 student loan debt, and that payment could be easily upwards of $1,800 a month, and they could be buying a home for $250,000 with a $1,500 payment with taxes and insurance. So yeah, it's interesting. That's why the home purchase doesn't seem like a big ticket item like it did to past generations. It was the biggest thing they ever financed. Now we're talking about could be the second biggest thing they've ever financed.
So when you talk with these young people or first-time home buyers, they see that payment and they compare it to rent. But I know as a homeowner what kind of expenses. I mean, we just spent, I think, $30,000 doing new siding and this, paint that's going to last forever and doing repairs because we live on the lake and, we had water rotting on the wood because it's an old cottage, all this stuff. And there's so many expenses. We did the roof a few years before that. So there's $50,000 right there that if they don't budget for it, they could end up in dire straits and lose their home even.
Well, that's why the homes that they're purchasing typically are the homes that are more compact, that are renovated recently, that have very low maintenance to overhead expenses. And as a whole, the problem we have is the retirees have already moved out, at least in our area, the Midwest, of those homes. So there aren't enough of them on the market, which has caused the price of those smaller homes to skyrocket. Mm-hmm. In some areas in Michigan, they've gone to $200 to $300 a square foot, which is more than a luxury home may be, dollars per square footage. But as far as what seniors have been looking for, the problem is a lot of seniors here are looking for ranch-style homes or single-family units. So we don't run into that many builders that are building that type of home. And the previous owner homes, there aren't that many of them that were built in the past.
Wow.
Yeah, it's been an interesting transition, this 10-year run. I like to always say it's usually the curse of the eights. In 1998, we had a market scare based on foreign currencies. And 2008, nobody has to be remembered as to what happened. Here we are, 2018, and I have that feeling just on the back of my neck that the markets may take a turn. I don't think it'll be housing this time. There were no risky loans done in mortgages, but student loan debt has tripled along with credit card payments.
Yeah, so that's the thing I'm worried about. Our nation, our national debt has just skyrocketed. So our nation has a debt, and with rising interest rates, our interest payments just alone could surpass our military budget. So when you've got that going on, it's going to have to get paid somehow. It could mean higher taxes, and we've already seen. That's my other question for you. We've already seen how higher taxes can affect people in the real estate markets because the people on the coast seem to have the highest property taxes. Like my friends live on the coast in Long Island, and their property taxes for a normal house, a normal 4-bedroom home, I think were almost $20,000.
Yeah, and the new tax basis only allows us to write off $10,000 of that now.
So how is that affecting real estate in the work you're doing?
Well, again, the majority of our business is from the Midwest, even though we do the coast and we do a lot of Florida properties. It hasn't affected us much because the people that have to deal with that are typically people with a higher income level. So even though they may be affected and lose a $5,000 to $6,000 benefit as far as taxes, it doesn't stop them from purchasing a home. The biggest thing that people are concerned about right now is the loss of mortgage interest deduction. And everybody says to me, well, mortgage interest deduction hasn't been taken away. However, 90% of people that claim mortgage interest deduction last year won't claim it this year because of the new minimum $22,000 for a family that you're able to claim in expenses. So if your mortgage interest doesn't equal $22,000 along with your other tax deductible expenses, you won't claim that mortgage interest. You'll take the $22,000 as a side note because you'll get a larger benefit out of that $22,000 than you would of your mortgage interest. So when you talk to your tax advisor this year, it's going to be interesting to see if the mortgage is a quote unquote benefit like it used to be. And I don't know if they will. I think that's a bigger thing than even taxes.
And remember, two of the best planning tools were putting away for your retirement in the pre-tax, 401k or IRA, where you get the deduction, and your home interest deduction.
Correct. And now that whole thing changes when you look at it. Now, home equity, or the amount of money you're building up in the value of your home, is something that people need to start considering as an actual way, or an actual checking account, almost, in the form of what we'll discuss later, in a reverse mortgage. Even in a forward mortgage, a lot of people today are taking equity out of their homes, because even though rates have slightly gone up, they're hovering around 5 to 5.25% right now. Historically, that's still incredibly low, depending on where you're at and your original mortgage. I remember mine was at 8.5. I don't know what your stories are. I'm sure yours were even.
When I started in the business, when I started with American Express Financial Advisors back in 1987. They were double digits. And I remember the first IRA we did was like 20% interest.
Okay. So
maybe 18%.
My stories of 8 are crazy. Your stories of 18. So you got me beat with that.
But that was on a CD, that was on a CD, but the double digits on the mortgage interest rates. Yeah, it was about 30 some years ago. So
that's amazing. I mean, to think about that. So I have clients that are willing to take the 5.25 today, locking it in for a long term, to pull equity out of their home to do home improvements and or to fix up their home. At any time you want to borrow against an asset, I don't care if it's a stock, if it's whatever it is, anything, you should borrow at its peak in value. And today, housing has hit its peak. Now, could it get higher? Could we see an even higher peak? Of course. But the chances of it going down from here or stagnating are far greater than it keep increasing, because we're already surpassed most areas median income level. So if you've surpassed the median income level of the potential buyer, houses can only go up so fast until incomes increase. And that hasn't happened.
It's happening, but slowly.
Correct.
It's happening, but slowly. So one of the things we talked about before the show is we wanted to talk about this idea of retirement planning and using the home as a retirement planning tool, about government benefits. So I think, that leads us into this idea. So can you talk a little bit about what you'd suggest for someone planning to buy their home to retire into versus these millennials we were talking about?
Wonderful. A good example, if you don't mind me using a personal example, would be my father. My father is a recent retiree. When he turned 70, he and my stepmother both were having the issue of an upstairs, downstairs condo. Even though they didn't listen to me and recently renovated it, and it was absolutely gorgeous, there was no way to put a lift in this unit. With his hip replacement and with her having some other health issues, they came to me and said, "What do I do?" The reason they had a problem was their condo value was roughly $250,000. They paid the value of that condo down to almost zero. But the least expensive ranch units being sold in our area were nearly $500,000. And the last thing they wanted to do was take on a new mortgage of $250,000 after selling their condo. So they were really stuck without any solution as to how to get into that ranch house. What I was able to do was explain to them, based on their situation, that doing a reverse mortgage for a purchase is the least used way to do a reverse mortgage. People don't understand that a reverse mortgage, in terms, is insured by FHA, Federal Housing Administration, from the federal government. It has an insurance policy that the value of your home, if it ever decreases, will not have to have any there won't be any leftover equity issues when you go to sell that home, whether you be retiring out of that home into an assisted care facility, or whether your heirs would sell that home. So you are 100% insured against there ever being a shortfall in the house. They had the same questions that most of your listeners will probably have, which are, what in the world do you do? And how does a reverse mortgage work? And how can you even use it on a purchase? For them, it was very simple. At the time last year, the values were at a percentage where they only had to put down 50% on the purchase price. So they ended up negotiating a purchase price of roughly $440,000. So their down payment was $220,000. The other $220,000 would normally be in the form of a regular mortgage with a payment. In their case, in their scenario, that mortgage was done in a reverse mortgage, so the payment itself will be accruing interest every single month, maybe for 3 years, maybe for 30 years. They get a statement every month, but that payment will never have to be made until they exit the home, whether they leave it and they want to sell the home, or they leave the home because their heirs at that point are selling their property because they're no longer with us. But they're insured to be able to live into retirement until the second to die would actually be the one who would then have to sell the property after they leave. So if one outlives the other, they said to me after looking at the numbers, sitting down and talking with their financial planner, the question my father had in his joking manner was, why doesn't everybody do this? Now I bring it to you. When you and I discussed it, you said the same thing to me. Why doesn't everybody do this? I don't know what the answer is.
So tell us, like in very simple terms, what your folks did. You're saying the house they were in was $250,000. It was
Correct.
a condo. To go into the ranch, it was going to be almost $500,000, but they were able to negotiate down to $440,000. And they took their equity from this condo, put it down on the ranch house,
and never have to make a mortgage payment again. So they put $220,000 down instead of $440,000 like the normal person would have to do to have no mortgage payment or pay cash for it. So all they had to do was put half down, and that's based on their age. So there is a calculation for reverse mortgages, but in doing so for them, it gave them the ability to move into a new construction ranch home where most people don't utilize a reverse mortgage in this way. So as far as a personal story, I think that was, there are nuances and details also to it. But when you and I discussed that the first time, it was pretty amazing to see that can be used in a form to purchase a home, not just refinancing to pull money out of a property.
So when we were promoting to do the show, I did get a question of someone who said that they were afraid that someone would be kicked out of their house because they used up all the money that was they used up all the equity that was in the house, and they were afraid that their parents would be kicked out.
Well, that along with the other two biggest fallacies are people don't understand how a reverse mortgage works, and the fear of not knowing makes a lot of them not look into this as a possible retirement plan. You can never be kicked out of a home as long as you are on the mortgage and you are living in the home under 3 conditions. The 3 conditions that have to be met are: you have to pay your property taxes. Obviously, the state can always foreclose on a house if someone doesn't pay the taxes on their house. 2, the maintenance on the property, if it is a condo or an association, does have to be kept up. So in other words, somebody does have to still pay the property taxes and the maintenance. However, the mortgage itself can't be paid. Or 3, and the most common time that somebody could be forced to sell their home is if they're not living there anymore. What's occurred with reverse mortgages are mom and dad go into a retirement facility, and then there may be somebody else living in the house. Well, at that point, the reverse mortgage would require whomever's in charge of the estate to then sell the property. But even if the value of that home that my parents bought for $440,000 somehow dropped to $200,000,
okay,
and the year that they sold it, they had owed, let's just say $400,000 because they had lived there for 20 years without making a payment. The additional $200,000 plus real estate cost would be paid for by FHA. So FHA, the Federal Housing Administration, takes out an insurance policy for that couple that's doing the mortgage to make sure that they will never owe a penny more than what it is they put into the property. In other words, they will not owe anything when exiting that property.
So they don't have to die in the house. They actually can leave the house to go to some kind of assisted living or nursing home. Pardon?
And then the house could either be sold or if they decide to move back into the property, they can do so.
So, and if they, can they keep the reverse mortgage going if they have to go into a facility for a short period of time and come back?
They can. That's actually a wonderful question. It's actually written that there is a 6-month window. So you can keep that property for up to 6 months. If after 6 months they haven't, they can petition FHA to allow them to keep the home longer. However, one or both have to be in the home at some given time. That's how the mortgage is written. Now, it's not as though FHA is knocking on your door to see if you're living in the house. It's pretty much an honor system in that sense.
Mhm.
So I've never had a client that's ever had an issue with that. But a lot of people do ask, well, what happens, Jason, if the value of a home, and let's use the example that we have on the table, the $440,000, keeps going up in value. And let's say one day it's worth $600,000, and my parents decide to move to a retirement facility, or they're no longer with us. And let's say there's only $400 owed. Does the government then keep the equity in the house? And the answer is no. Just like a regular mortgage, you would pay that loan off, and the difference, the $200,000, would go to the estate, or it would go right back into the parent's account. But doing so always gives them the benefit. The benefit is always on the side of the borrower. It's one of the few things in a mortgage where benefits are always geared towards the borrower.
Wow, that's great. So is it Tom Selleck that's doing these commercials on reverse?
It is, yeah.
He's now a senior, right?
Oh, he is. It's amazing to think that Magnum PI driving that Ferrari 308 is now in that generation that would have a reverse mortgage. But absolutely, he's the biggest cheerleader there is. He and Henry Winkler, if you remember, he did some ads as well up until about a year ago. So Fonzie and Magnum were both our cheerleaders on this front. But neither of them really pushed the reverse for purchase, and that's what I use it for more often than not. Even if you had the equity, even if you had the money, why waste the down payment? If you're going to buy a house for $500,000 and I tell you only have to put $250 down and keep the other $250 in the market, what would you tell me?
Well, let's think about this too, because one of the reasons I left financial planning after 20 years is I found myself wanting to work with people on more creative things, reinventing retirement, starting a business, and the idea of them being able to reinvent a bit and maybe earn some money in retirement can mean if they can earn $10,000 a year doing something they love, that would be equivalent to pulling 4% a year out of a $250,000 portfolio. Right. Let's say they're taking the dividends from it. So I talk about creative ways of accessing income. So one could be, working part-time, turning a hobby into a business, but doing something you love. Another one that I never really talked about was this idea of pulling income out of one of the biggest assets that we have, which is our house. By the time we retire, we have so much equity. My husband and I already have, I believe, $500,000 of equity in our house. And 10 years from now, we won't have a mortgage left. And so are we supposed to just sit on that just because we don't want payments and then leave the house to my kids? And they don't really want the kids.
Wouldn't they rather have
they can't both live here.
Pardon? I think they'd rather have a bank account with $500,000 in it rather than a house free and clear that they have to sell later on.
Yeah,
if you think about it, you decided to do a reverse mortgage today, and let's say you're able to gift each of your children $100,000 towards the purchase of their home by utilizing a reverse mortgage. You're essentially giving them their inheritance while you're still alive to enjoy and watch them enjoy the money that you were going to give them. And you didn't even have to take a penny out of your savings account to do so. You could utilize a reverse mortgage to do that.
Oh, I love that.
Yeah,
I love that.
It. Think about being able to see them enjoy without having to affect your own personal nest egg. And it's not as though the house is going anywhere. You still have 100% ownership of that property, just like you would with any other traditional mortgage.
So we're going to talk about that. So you talked about your dad putting the equity down so then he and your mother wouldn't have payments.
Correct. And then he also didn't have to liquidate the money out of his savings account. So he was able to leave that in there earning income for him and for my mother during retirement.
But for them to have no payments, they would have had to pay cash.
Correct. So that other $220,000 that they were able to save is now sitting in their retirement plan, not being put down on the property. Obviously,
so they can take vacations and pay for all their living expenses.
And they took a big swing because their old mortgage was a 15-year mortgage. So their payment was somewhere around $1,800 a month. So they went from $1,800 to zero immediately. And that, with the exception of the fixing up and the redoing the basement, as people like to do, that home is completely mortgage free for as long as they live. And if one outlives the other, it's still that spouse that stays in the property can stay in that property until they are no longer able to stay in that property, which also allows caregivers to be taking care of somebody at home instead of in a facility, which allows a lot of people that comfort and peace of mind that they don't have if they don't have the option of not having a mortgage payment.
Okay, I'm gonna have to ask our friend, the elder law attorney, this question, unless you know the answer. So, how does the reverse mortgage work for individuals who are looking to qualify for government benefits like Medicaid and veterans benefits?
Now, I'm not exactly sure how it would affect now if they did have a mortgage payment previous to the reverse mortgage, and that was part of their qualifying debt. This would not be included in today's scenario. So essentially what would happen is if they had an $1,800 mortgage payment that's now a zero mortgage payment.
Okay, you can go ahead and take care of that and then come
back.
I
apologize. If they had a mortgage payment that was $1,800 and that was used as a calculation, now that mortgage payment would be zero. So I would tell them they'd still have to check with their attorney, obviously.
Of course, yeah.
Now, with a reverse mortgage, however, the amount of cash they pull out of the property, if they do a traditional reverse mortgage, that may also affect their ability to collect benefits, because if they don't have much money in their accounts now and they pull 50, 100, 200,000 out of a property, that may also affect their ability to claim benefits.
And see, this is why we have to work with a team.
Absolutely, 100%.
And that's what you and I do.
As a mortgage advisor, just like you are an advisor to your clients, when it comes to finances, when it comes to insurance, when it comes to wealth preservation, I'm an advisor to my clients. I never sell, I only tell. And I always try to teach the guys that work for me the same thing. The reason I'm still doing this 22 years later is because I'd rather give my advice away for free and then have people come to me for that question answering, because that's when the relationship, I think, is really built, when you have a trusted advisor.
And see, what you and I can do is call someone like the elder law attorney that referred me to you, Don Rosenberg, who's in Troy, and he's a really qualified elder law attorney, but he referred my client to you. Now, she ended up not doing the reverse mortgage because she doesn't feel that she's going to live there that long. Yeah, her husband's very, very sick, and he's got
situation. She still was working full time too,
and she is right, and she's probably going to downsize into something later. Then it might be a great tool for her at that point. But she wants to, if she can move to a place with no maintenance and downsizing, it could make a lot of sense at that point. So let's talk about, I have just another question for you. So when your father was able to have no payments by putting down enough so he didn't have to have payments, and the reverse mortgage became, what was actually happening is the interest on this loan is accruing inside this mortgage. There are people that they can actually be taking money out in a lump sum or in monthly installments if they want to. Tell us how that works. Is that when they have a house that's paid for in cash?
Let's give another example. Let's do another example of another client. I always like to use real world examples.
Okay, good.
I have another client that owned a home, and the home was worth $400,000, and that's a good round number for us to use as this example. That house was owned free and clear. So most people realize, hey, I'm sitting on a $400,000 piece of equity. However, it doesn't do anything for me except for provide me shelter. Doesn't matter if it's worth 400 or 4 million, because until I sell it, I can't access any of that money if I don't want to have a mortgage payment. Well, with this particular client, they didn't need the money. However, they were looking to see what they were able to qualify for on a reverse mortgage. Client, both age 75 and 76. And when doing a reverse mortgage, I always like to use rule of thumb calculations. It's not an exact science, but the rule of thumb is your age minus 25 is the percent that the banks, through FHA, will allow you to take out a reverse mortgage. Not an exact number, but a really good guess. So if the younger of the two borrowers was 75, we were talking about half. So half of 400,000 or 50% would be a $200,000 reverse mortgage. So that equity could either be taken out in a lump sum, and the lump sum would be roughly 100,000 now and 100,000 after 12 months. They used to let you take the entire equity out at closing. That's gone away. They wanted to make sure that people still have enough money to take out later on. Or they can take it out in the form of a line of credit. So they can take out 100 now and then have a $100,000 line of credit that grows annually if they don't access it. So that available additional 100,000 is available to them at any point. And that's the decision that the borrower of mine decided to take.
How does how does this line of credit grow?
Oh, it's amazing. So the line of credit, based on a calculation that I'm not even going to get into, grows at a rate of between 1% and 4%. So if you take out a reverse mortgage, there's a cost of living expenditure, and there's also another calculation that the banks will use that says that a second $100,000 that you took out actually will grow. So if you don't access it year one, there'll be 102,000 available to you. Again, so on and so forth, 104, 105. So many people take it out and don't actually use the secondary line of credit and just let it grow. And if they ever need that money later on for a caregiver or for other expenses, they have it available to them. But remember, at this entire thing, we had a person with a $400,000 house that did not access any money from it, that looked at it and said, wow, this is a wonderful asset, but it does nothing for me while I'm living. Now he was able to take $100,000 out for home improvement and has this other $100,000 line available to him later on in life for whatever expenses may arise.
Well, and one of the expenses that is going to happen, and I said it earlier, that if you're over 65, 70% of us will need some kind of in-home care or assisted living. And the stats are 65% will need it right now, currently are receiving care in home, maybe from a family member, or they would have this money available that they could bring in caregivers.
And look at that. They're all doing so within the comfort of their own home.
Yeah.
It's actually looking at the home as a living, breathing tool. Your home itself has equity that isn't going to be tapped until you sell it, unless you access it through a reverse or a forward mortgage. If you have a forward mortgage and you borrowed $200,000, there'd be a $1,300 payment. With a reverse mortgage, there is no payment. You're utilizing the equity today while you still can enjoy it.
Wow, that is amazing. And so I told you about my situation, and we had been talking about when let's say 10 years from now, my husband no longer wants to keep doing all this work around here because it costs so much to put the boat in and take the boat out and maintain a boat and all these different things, because we live on the water. And so he was saying, well, we could just sell the house and then downsize and invest this money. Right. We're going to invest it in the stock market when we're 70, right? And then have it drop 50%. So let's talk a little bit about that. The difference between doing this, where you're guaranteed you're going to get this income, and versus, and even if, versus having to downsize, move to a different house, smaller, and then.
Well, first of all, the fallacy that there is a smaller house is there isn't. Let's all be real. My father was living in a home for 32 years. Was worth $250,000. He bought a home worth $440,000. That's the downsize in today's market. In other words, if you want a ranch and you want to maintain your existing lifestyle, it's going to be more, not less. And you'll be competing with millennials purchasing, because they're the ones looking at homes between $100,000 and $300,000. So everybody thinks they're going to downsize. They're not. They may downsize the square footage of the home, but they sure as heck aren't downsizing the purchase price of the home. So that's what I always like to remind people. It sounds good in theory to downsize to a small house, but if I told you what you could buy for downsizing and you went and looked at an 800 square foot bungalow built in 1953, you'd look at me like I was insane. So that's not really what people want. They just want to think they're going to downsize. They may get a smaller home. It's going to be equally expensive though. And that's the problem. There aren't the communities being built, especially in the Midwest, where there are homes being priced anywhere under $500,000 because the land is too expensive. Florida still has construction in some areas under $500,000. Texas does, but very few states do. You could laugh if you said that $500,000 in California doesn't buy you a piece of dirt.
Yeah, in North Carolina, I think my sister-in-law is there. Lynn, who was helping us, she said the real estate is still pretty reasonable there, which so everyone's
going to force you to move outside and away from your kids and your family. So that tell me again, how many people are going to actually downsize?
Yeah.
That's the laugh that I always tell people. It sounds good in theory, but downsizing may not be down pricing. And then you have other expenses, moving expenses, equipping a home for your senior life. You want to have certain things. You don't want to have to do without. The idea is not to do without. The idea is to enjoy all the work you did. Why downsize?
So the nice thing is that money, and I just want to let you know, we're coming towards the end of the show. But that money can be available, that line of credit for repairs, because that could be one of the problems is they don't have money to take care of the home and do those repairs like ours came up, the roof and that. So, that is a great thing to just have that line of credit that they can maintain the house and keep it up for themselves.
Every person has a unique situation. Every person has a unique desire. The idea of retiring, I feel as though people shouldn't look at it as something to be afraid of or something to worry about. It should be something to enjoy and be excited about. So even if you are looking to purchase that next house, if you're looking to downsize, if you're just looking for advice, I mean, a person like myself, I'm always available to anybody for free advice, but there are a lot of people out there that are in my community. We're called mortgage brokers. As I said, we're typically the ones that'll give you the advice. We're the advisors of the industry. We aren't bankers. We aren't loan officers.
Yeah, tell us the difference between that, because, in the old days, you would go to your bank and go get your loan. How many people actually go to the bank where they have their checking account, savings account for a loan? And what's the difference between...
1 out of 3 go to a bank, 1 out of 3 go to a broker, and 1 out of 3 go to a mortgage company. And banks are banks. That's where you do your checking and savings. They have access to one product, the product they offer, and that's what they tell you or sell you. A broker or a mortgage company have access to, for example, we're signed up to do business with over 60 different banks and private lenders. Wouldn't you like the option of 60 instead of 1? Wouldn't you like the advice of somebody that actually will sell you or tell you what's best for you instead of what's best for their bank? That's the big difference.
And what's the difference then between a mortgage company or a broker?
A mortgage company holds on to their own paper. A mortgage broker sells. So I decided a long time ago, I didn't want to take on a back office of 50 people to service the loans that we produce. So we actually sell them to mortgage banks and or large banking institutions. So the only difference between one to the other is I say the mortgage broker is the lean, nimble, least expensive way to do business. The mortgage company is your second best choice, and then banks are third. Banks, as we know, have one product. Mortgage companies have multiple products, but they have big expenses. Mortgage brokers, such as myself, have very little to no expense, which is why we're always the least expensive cost alternative in the industry.
And you gave some great advice earlier about the zero cost and then taking a little bit higher interest rate. So,
and when I say a little bit higher, it's so negligible. It's the price of a few cups of coffee, and you can get a bank to pay $2,000 to $3,000 of your fees if you have a broker working for you to negotiate on your behalf. And we get paid not by you, the customer. We get paid by the bank. So it's amazing when people say, "I don't want to go to a broker; they cost money." We cost nothing. We are literally a free service to people shopping for a mortgage. We're a trusted advisor shopping on your behalf.
Wow. Well, I had always loved to have our guests share what we call our smart money tip or our smart women tip. What would be your tip for our listeners that you'd like to leave?
My tip is you always follow the ones that are smarter than you. And if Warren Buffett says the stock market is the most expensive it's ever been, with the exception of 1999, the next time you have a conversation with your financial planner, I would make plans and prepare for Warren Buffett being right.
So put all that together. We have high prices on homes, and we have a high price on the stock market.
I'm not making any conclusions. I'm just giving you the truth. The truth speaks for itself.
Wow. Well, it has been so wonderful having you on the show.
Thank you. Thank you for the opportunity.
Oh, absolutely. So, everyone, I hope you go see Jason. And Jason, how do they find you? Give out your website.
Very easy. Atlantis, like the lost city, Atlantis mortgage.com, or you could just do a Google search and you'll find me direct to my cell phone. Jason Yourofsky, and the last name is spelled Yourofsky. Put those 3 words together, Jason Yourofsky, and you'll come right to my cell phone number if you type that into Google.
That is perfect. So that's good about having an unusual name, right?
It does make it a lot easier to find me, yes.
Yeah. Yeah. Same thing with having my name too. So again, thank you so much for joining us. This has been wonderful. I think you cleared the air finally on reverse mortgages.
Thank you.
Okay. So thanks everyone for joining us this week. Remember to join our free Smart Women community. Go to joinsmartwomen.com. I want to see lots of these coming in. When you do, you're going to immediately receive 100 days of inspirational quotes by women. You'll get our monthly easing. You'll know when our shows are. You can take the Smart Women Academy and go into the Unlock Your Financial Power course absolutely free. Next week, our guest is Nicole Whipp. She's an elder law attorney, and we are going to be talking about why estate planning is not enough in today's world, how to protect your money in the event your loved one needs care, what we've been talking about today, and ways to avoid probate. You're going to learn stuff you never knew. So don't miss it. And until next week, go out and live with more purpose, passion, and prosperity.
Thank you for joining us here at Smart Women Talk Radio, a place to learn, prosper, and grow. Tune in again next week for another exciting episode of Smart Women on the CTR Network. And remember to live with purpose, passion, and prosperity.